Today we're talking mutual funds. And no, it's not a fund where we all pitch in to buy more salmon, although I'd invest in that. A mutual fund is kind of like a big pot of honey. You, me, and a bunch of other investors toss our money in, and a professional manager uses that pool to buy a mix of stuff, stocks, bonds, sometimes both. That way, even if one investment goes sour, you're still covered by the rest. It's a way to spread out your risk without having to climb every tree on Wall Street yourself. Now here's where it gets fun. An index fund is actually a type of mutual fund, but it's what you'd call passive. It doesn't try to outsmart the market. It just tries to be it. For example, an S&P 500 index fund owns the same companies as the S&P 500. No guesswork. Nothing fancy. Just tracking the whole market. Nice and steady, like a bear floating down a lazy river. But not all mutual funds are like that. Some are actively managed. And that means there's a person or a team trying to pick the winning stocks and beat the market. These funds aim to do better than the index. Sometimes they do, sometimes they don't. But they usually come with higher fees, because someone's getting paid to make all those decisions. So when you hear mutual fund, think of it as the umbrella. Under that umbrella, you've got index funds, which are low cost and just track the market. And you've got actively managed funds, which are trying to do better, but might charge you more along the way. Oh, and if you like this little fireside chat, don't forget to give us a thumbs up, subscribe to the channel, and drop a comment with your questions or thoughts. Hungry for more? Head over to the Den on growlstreet.com for deeper dives and bonus content. Thanks for watching. And remember, even in the wild world of investing, you don't have to go it alone. Just follow the bear.